failed to clearing the cache. Yeah, that's probably why I see it's that they don't allow cookies. And I don't know, I feel like they're being like hyper I don't know how to put it, like super conservative with the way they allow people to access the Wiley site. And then the other thing that also happens, and see, thank you for bringing this up. Somebody else had also contacted me. See, I don't know if it was you or somebody else contacting to say that they couldn't get into Wiley, and it turned out that that person's browser was blocking pop-ups, and it was some type of pop-up that needed to come up in order for them to be able to start the homework. So please make sure that you're allowing pop-ups from that site. You don't have to allow pop-up from every site. I know that there are sites that are, annoying with the pop-ups, but please make sure that you're allowing pop-ups from Wiley. Make sure that if you can't get into Wiley, that you've cleared the cache. If you've cleared the cache and you're still having access issues, try a different browser. And if you've done all of that, try a different device. And if there's really still a problem after that, I'll speak to the Wiley rep. And I know it sounds like a lot, but the bulk of the class is not having this issue. It's like 2 or 3 people that are struggling with this. So, I don't want to give this impression that Wiley is just like awful or something. It's nothing like that. It's just that for whatever reason, 2 or 3 people, and I'm sometimes part of that problem that can't get into to Wiley, right? So this is all part of saying make sure you are trying to start the homework early. You don't want to find out on Monday at 2 o'clock that you can't get into Wiley. And then, good morning, Tanisa. And then then I've left my desk because my office hours end at 2. And then you're emailing me, and I only get back to you at 3 or 4 o'clock. And then you've got 2 hours to do the homework. I'm not extending homework deadlines because the homework the homework for everything is available from the beginning of the semester. I'm not saying that you would have been able to do it since the beginning of the semester, but we finished chapter 13 already on Tuesday, which means that you have a whole week to do the homework. If you started on Tuesday and you only did one question per day, you would be able to finish the homework, just by doing one question a day by this coming Tuesday, right? So please think about how you're going to plan your time between now and Tuesday to be able to successfully complete this homework. Everyone should get 100%. There's unlimited attempts. There's no points being deducted. You're just popping 5% in the bag, for the class. All right. So that's my preaching done about homework. And remember the homework, well, actually my preaching will now continue briefly. The homework is looking like the test, okay? The last time, and this will probably be the same, this question, problem 13.1, was a question on the test. It's going to be a question on the test. So just do it. If you are seriously pushed for time and you can't do much, remember this thing is 4 points. The others are 1 point each. Make sure that you're spending your time wisely, that you're not leaving this question out completely. This is the question that was one of the, or will be, I shouldn't even say was, it will be a big question on the first test, and it will be for a lot of points. So I don't hide from you guys what's on the test. If you want to know what's coming on the test, it's already on Blackboard. Okay. So, over here, I tell you there will be exercises. These are the exercises that will be on the test. And it's like, this is the problems that it looks like in your homework. So, this is not a mystery. I want you guys to succeed, but you're going to have to do the homework in order to know how to succeed. 13.1, see, the same question you were asking me about is in the test. Okay. Tanisa, go ahead. Tanisa.
It was the same question. I'm sorry. You
That's
just
fine.
answered it.
Yeah, so everybody mark your whatevers. This question, problem 13.1, is in the test. Okay. And it's in the homework. You need to do the homework. I'm not giving you homework to waste your time or because, I'm sitting somewhere in my tower, like twiddling my fingers, excited that I'm like torturing everybody. No, I'm giving you the homework because I want you to be able to do well on the test. And so when you look on the test and quiz information page, you will see that the first question on the test is the same question that you had for homework, the numbers will be different, but it's basically the same question. Okay. And there are other questions that are also similar. I'm writing for you, yeah, which questions are similar to which homework questions that you had so that you can focus your studying in on that. Yeah, see, I'll talk to you later about 1307. I have to revisit and make sure that I'm giving you guys it might be brief exercise 13.7 as opposed to exercise. I'll go closer to the test time and make sure that I have um, all the question numbers accurate. Yes, Tanisa, are you asking me again, or is this the old hand?
Yes. Again,
Okay.
so for the homework, are we able to go back to the questions that we've done? For example, like in chapter 12, like are we
Mhm,
able to go back and see?
mhm.
Okay.
Yeah, you have access. So when so 12 is obviously not on this test, but 13 and 14, once you finish, I set up the settings so that you will have access to you need to be able to study. So
Right.
you definitely have access to the questions. I don't know, I don't think you can like do them again in Wiley because the thing is already recorded. But what you can do is, look at the question and try to answer it manually or however you normally study. All right. So, but definitely you have access to the questions. It's not locked. It shouldn't be locked. Otherwise, it defeats the purpose of you being able to study. And see, I will audit my numbers on the questions to make sure that I didn't put exercise instead of brief exercise. All right. Anything else about homework or anything? I mean, I guess I'm talking, but I just want to make sure that no one has any other questions about that. All right. Okay. So without further ado, then we'll continue here talking about dividends. So these two chapters are linked, right? Chapters 13 and 14. 13 was obviously all the issuance of stock and all the scenarios around that. And then 14 is still continuing with corporations, but looking at dividends, and we'll do cash dividends and stock dividends. So, a dividend being the company sharing some of the profit with the shareholders, giving them, some amount of income based on the number of shares that they own. Excuse me. And then we look a little bit more into retained earnings and how to calculate retained earnings, especially if maybe we find an error from a previous period and we have to adjust for that. What does net income do to retained earnings? We already kind of know that net income increases retained earnings, but retained earnings is also connected to dividends because all the dividends are, paid out of retained earnings. Because again, retained earnings is all the net income and losses that we have kept in the business over the years. So when we decide to actually distribute some of that income to the stockholders, it is going to decrease our retained earnings because what we're saying is that we are keeping less of the income in the business and actually then distributing some of it to the owners. And then income reporting, just it sounds, maybe a little bit sophisticated, but it's really just the income statement. And I told you before that for companies, we still have the multi-step income statement, the chapter that you would have seen lost in chapter 5 in accounting 1. And obviously you have the textbook, so you can go look back. But when I'm talking about multi-step, it's basically saying sales less cost of goods sold gives you gross profit, less operating expenses gives you income from operations. And then maybe you have other gains and losses or other revenues and expenses, which then gives you income before income tax. And then you deduct an income tax expense to get to net income. We will do examples, so don't panic because you're thinking, oh my word, I'm reciting all this stuff and you can't write it down fast enough. I will give you multiple examples to see how it goes, like how it works. But I guess the biggest differentiator here for corporations, which we've mentioned before, but I'll say again, is that you are paying tax. You have a tax expense for the corporation as opposed to partnerships and sole proprietorships where the income does what we call it flows through the organization, and it's actually the individual, so the partner or the sole proprietor, that ends up paying the taxes in their personal capacity. This is also what brings about this notion of double taxation in a company, and we ran into it in chapter 13, and this sometimes comes up as a multiple choice question of, one of the drawbacks of the corporate form is that the company gets taxed on the profits, right? It has an income tax expense, and then when the company distributes the profit to the shareholders, then there's another tax because the shareholders are then taxed in their personal capacity. So basically, the same income is taxed twice: once at the company level, and then a second time when a dividend is paid out and people pay taxes in their personal capacity. Is that fair or unfair? I mean, it's how the situation works. Nothing we can do about it. That's how the tax system has been set up. If it was a partnership or a sole proprietor, the income would only be taxed once. But we know there are other drawbacks to sole proprietorship and partnerships. So talking about dividends, again, a dividend is a distribution of the income, right? A distribution to stockholders, and they say on a proportional basis or pro rata. So what that means is if it's a $1 dividend per share, if I have two shares, I get $2. That's what proportional or pro rata means. If I have 500 shares, I get $500 and so on. So the more shares you own in the company, the bigger the dollar amount of your dividend will automatically be, which makes sense, right? I mean, it doesn't make sense that everybody gets the same dollar amount for their dividends, regardless of how many shares they own. That would be, insane. People would be rioting in the streets. So it's a proportional share. The dividend can be cash, which is the most popular dividend to give. Scrip is it's just a type of almost like a promise, or it's type of stock, but not really. Don't worry about it. It's kind of an old-fashioned terminology, but it still comes up a little bit. Property. So, can you give property as a dividend? Absolutely. It's maybe for not necessarily a very big public company. My Facebook, I only have like what 5 stocks in Facebook, but my 5 Facebook stocks, like Facebook's not suddenly going to distribute some property in California, and I now own, like some tiny percentage of the property. That doesn't make any sense. A property dividend would be more like for a smaller corporation, maybe where there are fewer stockholders, and this property maybe even just gets distributed to 1 or 2 stockholders. And then you've got stock dividends, which is also fairly popular. This has also happened. I think last time I spoke about how some companies are kind of like expected to declare and to pay dividends every year because they've been doing it for decades, and people basically invest in some of those stocks because they expect a stream of income. And so sometimes if the company does run into problems and they aren't able to pay the cash dividend, they can't even borrow money to pay the cash dividend, they may pay a stock dividend just to kind of give the stockholders something. Even though it's not cash. But remember, if you get a stock as a dividend, you can turn around and just go and sell the stock and get cash in hand, right? If you wanted cash, but the company doesn't actually declare cash dividend, they declare stock dividend, you can sell the stocks that you get in the dividend and you can get cash. So it's maybe an extra step, but it's not so bad. So our focus will be on cash, sorry, on cash and stock. So that's where we'll spend our time. Dividends may be expressed in 2 ways: as a percentage of par or stated value of the stock. This number one is usually how we deal with preferred stock. It's a percentage of par or stated value. And then, or number two, where the dividend is just as a dollar amount per share. That's often how it works for common stock, where they just say we're paying 50 cents a share. For preferred stock, it's usually, we saw this last time also, it's like 7% or 9% or whatever. That percentage determines the total amount of the preferred stock dividend. And remember from the last time also, we pay the preferred stockholders first. The company usually declares total dollar amount of dividends, and then it, is split. If there is preferred and common, it's split between the two. And then remember from last time also, we have to figure out whether it's cumulative, whether preferred stock is cumulative or non-cumulative. So make sure that you pay everything that's owed to preferred stockholders first, and then common stockholders get the residual, the leftovers, right? It's a residual interest that they have. We'll see how to calculate that split a number of times. Again, we'll do some examples. Just a heads up, the part of this chapter where we deal with allocating cash dividends between preferred stockholders and common stockholders is usually where people get stuck. Okay, so please pay attention to that when we get there, and also make sure you do the homework related to that in chapter 14 when the time comes, because guess what? That question is also going to be on the text, all right? So that piece where we allocate between preferred stockholders and common stockholders for whatever reason gives people a little bit of a headache. So just make a star next to it that you need to pay more attention there. When we think about dividends here, there are 3 dates that are important. There's the dividend declaration date, declaring, saying. So it's basically when the board of directors are saying that they're going to pay a dividend. Then there's the record date. So the record date is a date by which it's like a cutoff where the company says all the owners of the shares, as at October the 7th, 2021, will get the dividend. And the reason there has to be a cutoff is that these shares are being bought and sold on the stock market all the time. So we have to create some type of boundary and say, up to this point, this is who we're paying. Otherwise, if you have no record date, you basically end up not knowing who to pay possibly, or people could fight about it because, what if I was holding the share the whole time and then I sell it, today I sell it to someone, and then suddenly the dividend is being paid tomorrow, and then I'm angry because I should have gotten paid the dividend because I was the one who had the investment in the company for all this time, but now somebody else is benefiting. So there are ways to sell the shares. It's a long story we don't have to go into, but there are ways to sell the shares where, you can still get the dividend and so on. But let's just say that the record date is going to be where the company goes through the books and says who are the owners, and these are the people whose bank accounts need to basically receive the shares. So you can imagine that's a lot of work, right? If you're a company that has hundreds of thousands of shareholders, it's a lot of work to make sure that you're paying the right people. In my, I think I told you this before, like I have some tiny amount of Apple shares and they pay a dividend from time to time. So, in my Robinhood stock account, I'll get a notice to say, like, to, yay, like today you received, I think it's like a penny or 2 cents or something of Apple dividends because you own Apple stocks. So that means that Apple went through their records at the record date and they saw, oh yes, Andrea Francis, okay, even though she only owns like 2 or 3 shares, she still is the one who has to get the dividend. And so on the payment date, I get my 1 or 2 pennies of Apple dollars, well, cents, as my dividend. So the declaration date when they say they're going to pay, the record date when they check who they should pay, and the payment date when they actually pay someone. Yeah, like 30 cents. What is going on here? It's going up. Oh, okay. Well, yeah, I mean, you know, the level of dividends, considering the amount of cash that some of these companies are sitting on, it's almost just laughable how small their dividends are. So on the declaration date, the board of directors authorizes the dividend and it announces it to its stockholders. So that's usually, if they're paying a quarterly dividend, that's usually going to be after they've already established what the financial statement numbers are for that quarter so they can see how much income they've made. So let's say they declare 25 cents or 30 cents, as you guys are saying, 30 cents per share dividend. At that date, the company is basically creating a legal obligation or liability to pay the dividend. Before that date, I have no right. I can't, knock on Tim Cook's door and say, "Hey, Tim, I'm tired of waiting. I want some dividends." You're not entitled to anything as a common stockholder until the board of directors actually declares the dividend. All right. So preferred stockholders are different because they have this, percentage dividend, and it might be cumulative, non-cumulative. It's a different type of arrangement. So they could actually be entitled to dividends, or they are, if it's cumulative, even more so because they have to get everything that hasn't been paid before. But common stockholders just have to wait it out and see whether a dividend is declared or not. Okay. Um, and I mean, preferred stockholders are entitled to something. That doesn't mean they'll actually receive it. The company still has to declare a dividend as well. I just want to be clear that I think I was maybe a little bit unclear there. That again, a preferred stockholder can't just go and knock on the door and say, "Hey, I'm supposed to get 9% dividend." Tim Cook will be like, "Yes, you're supposed to get 9%, but we haven't actually, declared a dividend, so you'll just have to wait until next year." It's too bad, right? But there are
Okay,
other,
sir.
yes,
Sorry. So isn't it like they pay dividends every quarter,
yeah. So
like
yeah,
quarterly?
yeah. So
Cause
some
and
companies,
also
sorry, go
yeah,
ahead.
and also don't they have like that area in Robinhood where they mention how much percent would they give on each stock?
Yeah, it will be like, yeah, exactly. I mean, you could see it on the company's, you could see it in the news, you could see it on the company's website. You may already know, because a lot of the times the companies just keep the dividend the same, like they don't necessarily change the
Yeah.
amount. And then in your notifications in Robinhood or wherever E-Trade or wherever you have your brokerage account, it actually will also say what was declared, so that you can also just check that you are getting, the correct amount of money. So yes, all that information is publicly available, as it should be. Um, and I guess, have I fully answered your question? I feel like I have, but I want to make sure that I
Yeah,
did.
yeah, you
Okay,
have.
all right. Yeah. Okay. So cash dividends, what's the deal? What do you need to have for a corporation to pay a cash dividend? Obviously, it needs to have cash, right? I mean, I know it sounds super obvious, but you can't just start declaring dividends if you don't actually have the money to pay it. So you must have retained earnings as well. So if I just started my business this year and I've been making losses, or if I'm Tesla from a few years back, right? Tesla only started turning a profit like a few years ago. Like with the pandemic, I feel like I never remember. Like I don't feel like I remember what happened in 2019, for instance. So I can't remember which year they started turning the profit, but it was before the pandemic hit. And so Tesla wouldn't be able to declare a dividend like in 2017 or something, because they were still making losses, which means they didn't have retained earnings. They actually had an accumulated deficit. So you can't declare a dividend out of a loss, right? You're not distributing a loss. A dividend is supposed to be income. So you must have income that you've retained over time, and you must have cash, and you must have actually declared the dividend. You can be sitting on all kinds of cash, but if you didn't declare the dividend, it's kind of, it doesn't matter. And I just wanted to say, let's not feel too sorry for the people who are holding the stocks if they're not getting dividends. So Google is Alphabet. Obviously, their stock is trading at 2,800 per share. Um, you know, Clearly it's going great guns. They have a market capitalization of over a trillion. They don't There's no dividend. When you see a dividend yield, that tells you like how much is someone is earning from them paying a dividend. There is no dividend. And I mean, does that mean that holding Alphabet or Google stock is like a waste of time? Absolutely not, right? Look what's happened over the past 5 years. Okay, did I have $800 to throw around in 2016, for one share of Google? I'm not sure. Maybe not, because I was saving trying to buy a house. But if I had had that money, I would have had a gain of like $2,000 on that share by now, 5 years later. So I may not have received a dividend from Google. Sorry, did I just say, yeah, 5 years later? I may not have received a dividend from Google for the past 5 years, but I have had what we call capital gains. I've had the stock price increase by $2,000 over the past 5 years. So I've definitely made, some money, and that's great. If we had to go into the 10K if we had to go into the 10K for Google, yeah, I wonder if they show the amount of cash. Yeah, I'm not going to pull up the 10K now because I don't want to waste too much time, but just for the quarter, right? Just a quarter, 3 months, Google made 61 billion in revenue, and they are not paying out dividends. So let me see if I normally they at least give a little bit of info. Yeah, cash on hand. Okay, that's what I was looking for. At December 31st, 2020. Yeah, cash on hand, 23 billion, billion with a B, 33% increase in the cash on hand year over year, or not even year over year, sorry, for the quarter ending December 31st. So it's 33% up. So there's 23 billion here. Why isn't the board of directors, as headed by Sundar Pichai, why are they not paying dividends? Because it's like I said the last time, they often just tell the investors that they are holding the money to reinvest, because reinvesting in the business and doing research and development is what's going to cause the stock price to go up even further, right? Remember, Google started from, some really tiny stock price, and people, especially those who came in back in the day. I mean, it's been 17 years. They've made out really well. When I was still auditing at Deloitte, I audited a private equity fund, and they probably went in on the first round or something of Google financing, and they bought it at 50 cents a share. So they've also made out big time. So why am I saying all of that? Because a lot of these companies have adequate cash. They have retained earnings. Remember, they're making billions of dollars in net income, but they are not declaring a dividend. So until they declare a dividend, nobody is owed anything. You can't go knock at Sundar's, door and say, "Pay me my money." They don't care. They don't have to pay you anything. All right. So sad but true. But in the meantime, you're making capital gains on the stock, because if you had invested 5 years ago, you would have a gain of $2,000 per share by now. Okay. So what are the journal entries, right? That's what we as accountants, we want to know, how do we account for these transactions? When we declare the dividend on the declaration date, the book will just show cash dividends, so I'll do that so that I don't confuse you. But the true place where the dividend comes out of is retained earnings. So eventually this cash dividend account will be closed off to retained earnings. So the debit eventually is actually to retained earnings, but the way it's accounted for is these intervening accounts called cash dividends and stock dividends. So you debit cash dividends, right? And then you credit dividends payable. The payable is the liability to show that we now owe the dividend, and the cash dividend account is basically recording the amount of the dividend to eventually be subtracted out of retained earnings. And I wrote here that the company, I should say eventually, the company eventually debits retained earnings, right? By closing, I see the comment in the chat. I'll check what it is now. I don't know if I'm missing a question. By closing cash dividends to retained earnings. That's a more accurate way to phrase that sentence. So the company eventually debits retained earnings by closing cash dividends to retained earnings, because a distribution of dividends to shareholders decreases the amount of net income retained in the business. And then dividends payable is a current liability. Current liability means it's a liability, but we expect to settle it within 1 year from the balance sheet date. And with these dividends, they generally get paid, fairly quickly after they are declared, a month or whatever, 2 months, maybe less. So it's current. Okay, so sometimes you have questions that ask you what kind of account is dividends payable. It's a liability. Payable implies that it's a liability, but it is a current liability because the dividend will be paid within 1 year from the balance sheet date. And then cash dividends gets closed off to retained earnings. Let me see what's happening here. What do you, I don't know what that means, Sam. What do you mean by is daily trade good? To day trade? Are you asking me about day trading? I think that's what you're asking me. And my answer is going to be no. No, unless you have 12 hours to sit in front of your computer and really go at it multiple times. And I mean, I can try and pull this up. I just have to find it, but almost categorically, it's been proven that day traders have not significantly outperformed the market. So you're doing, and what Sam is asking, guys, I'll just take a minute here as a sidebar. Sam is asking me if day trading is good. Day trading is basically when people go in and out of stocks or other types of financial instruments, trying to get profits, fairly quickly because of changes in the prices. And I'm saying to him that, multiple studies have shown, and also it's fairly well known in the industry that day traders don't significantly outperform the market. So what I mean by outperform the market, if I had to put my money into an exchange traded fund that is tracking the market, so I'm doing nothing, I'm like literally just putting my money into like let's say a Vanguard exchange traded fund that is following the S&P 500. I think that code is VOO because I have some money in that. I could do that, and someone else could be sitting and day trading, and over the same period of time, you could either end up being the same as me or worse off than me. But you are using so much time and energy and resources. So we generally don't encourage day trading. Now, someone might say, well, but I bought, X amount of cryptos and the next day it went up and I made a nice profit. That's true. Like when you're going through some of these quick transactions, you may find that you are making, a buck here and there, but over the long run, day trading is not shown to outperform the market. And then you have to remember that when you day trade going in and out of stocks, you aren't holding stocks for, more than a year. So that means that you will be taxed at your regular income tax rate as opposed to the capital gains tax rate, which is only 15%. So you also have to be careful that you don't end up with a big tax bill on your profits from day trading. So that's what I'll say. If you want to talk more about it, you can talk to me. We can talk another time. But yeah, day trading can be risky, and it doesn't necessarily bring the level of rewards that we think it will. Hopefully that helps to answer that question. If anybody has other interests in talking about stocks and stuff, I can talk to you during the break. Happy to do that. It's my other, the other side of my work. My majors are accounting and finance. So finance is the other side of my life. Okay, so the declaration of the dividends, just to repeat: debit cash dividends, credit, debit cash dividends, credit dividends payable, right? And then that's the declaration date. On the record date, there's no journal entry. Here the company is just making sure who owns the shares so that they pay the money to the correct people. Okay, so record date, no journal entry needed. The payment date is when we settle the liability. We say, okay, yeah, we show that we owe you the money, so the liability goes up on the credit side, and yeah, we pay the money, so the liability goes down on the debit side, and the asset cash also goes down on the debit side. So these journal entries are always the same. So it's kind of like that slam dunk kind of question. Hey, it's a cash dividend question. You know already when it's the declaration of the dividend, debit cash, credit dividends payable. When it's the payment, debit dividends payable, credit cash, not cash dividends, credit cash. Okay. And you're done. So the cumulative effect of all of this is that retained earnings will go down and cash will go down, which is exactly what we expect. So we'll do some examples here. Remember, all this stuff exists in the Zoom meeting materials over here. So if you want to follow along, you can. I forgot to. Oh no, I didn't. Wow, I was further ahead of myself, and I thought actually did move the exercises across. Okay, so I'm in the Google Doc. The link is over here if you want to go in there. So I'm in the Google Doc, and I'm going to read the first question and do it with you, and then you guys can do the second question. So 1A, B, and C is what we're going to tackle now, cash dividends. On December the 1st, 2018, the directors of Media General declare, there you can see it's a 50 cents per share cash dividend. So that's not a percentage, but an actual dollar amount per share on 100,000 shares. So you are generalizing the dollar amount of the dividend, so you need to calculate that 50 cents times 100,000 shares of $10 par value common stock. So here's an opportunity to get confused. We do not use the $10 par value as part of the calculation if you already have a dollar amount per share, right? That is being declared as a dividend. If this was a percentage, like a preferred stock percentage, then you would use the par value as part of your calculation. So in this case, you can ignore the par value, journalize the dividend declaration. So I'm going to go ahead here and start my debits and credits. Pardon. Okay. So dates are important here because you want to make sure that you are recording the stuff when you're supposed to. You're saying 50 cents times 100, so it's 50,000, and you are going to debit cash. Remember, I told you the journal entries are always the same, right? So 100,000 shares times 50 cents per share, $50,000, and the credit is to dividends payable. Okay, as simple as that. Same as what we just saw in the notes. That is the dividend declaration, just in case anybody got confused there. All right, that's 1A, part A. Now in part B, that's the record date, right? Where they say the record date for the dividend is December the 22nd, 2018. They're trying to be a little bit vague to check if you know that there's no journal entry. And we already know that because we read it over here. That's simply just the date where the company decides who owns the shares. There's no journal entry recorded there, right? So in this case, what you can just do is put no journal entry. I think in Wiley, they don't leave space for you to say no journal entry. I think you just skip over to the next thing, all right? But I'm just reminding you that for the record date, maybe just say that no journal entry on the record date. This is for the purposes of learning. We'll be a little bit more explicit in how we state that there's nothing to be done. And then in 1C on January the 20th, so notice how soon after the declaration we're actually paying the dividend. So that means, again, that the dividends payable is a current liability. On January the 20th, the next year, Media General pays the dividend. So January the 20th of 2019, you're going to decrease the liability on the debit side. It's the same 50,000, right? And not credit cash dividends, just credit cash, right? So this is the payment of the dividend. And that's it. Okay, so it's really not too, according to me, and hopefully that means according to you as well, it's really not that difficult to journalize these entries, always the same journal entries for cash dividends. Anybody have questions on this journal entry before I ask you to do the next example?
No questions. I actually was about to ask about part B, but then I was like, I know she's gonna answer it, so don't be scared.
Did I answer it?
Yeah, you did.
Okay,
yeah,
good.
because
Okay.
I remember you said not to have anything for record date. So I was when I initially saw the question, I was like, why is there something there?
Yeah, but it's not,
But yeah.
no entry.
Right.
Okay, good. Okay, Great. So example two, friends, let's go. We'll read it, but then you will do the journal entries. Okay, I'll read it with you, but you do the entries. So Bright Corporation has 100,000 shares of common stock outstanding. So there's the number of shares. Now you have to check if it's a dollar amount per dividend as a dividend or a percentage or what it is that they're declaring. It declares a $2 per share cash dividend. So there's your dollar amount. So remember, it's the dollar amount times the number of shares on September 1st. So September 1st is the declaration date. To stockholders of record on October 1st, that's the record date. The dividend is paid on October 31st, that's the payment date. Journalize the entries on the appropriate date. So again, this thing is being like super vague to test if you know that there's no entry on the record date. To record the declaration and payment of the cash dividend. So go ahead, I'll give you 5 minutes until 11:27, and then someone can walk us through the solution to that. I have two hands. I'll take C on this one. Denisa, I see your hand. I'll take you if you want to do the next one after the break. Okay, so C, just let me set up my debits and credits, and then you can give me your answer. What do you want me to do?
So on the declaration date, which will
Yeah.
be September 1st,
Yeah,
we'll debit cash dividends for 200,000,
yeah. So it's
and,
100,000 shares times $2 per share. Yep. Thank you.
and then we'll credit dividend payable.
The current liability, dividends payable. Yes, that's the declaration date. Thank you. What's next?
And then on the record date, which will be October 1st, we'll have no entry.
Yes, good, because we don't actually have a transaction on that day. They're just looking through their books to see who owns the shares. Continue.
And then October 31st, on the payment date, will debit dividend payable for 200,000
Same
and will
amount. Mhm.
credit cash
Thank
for
you.
the same amount.
The same. Okay. So the amount doesn't change between the declaration date and the payment date. And on the declaration date, you use the account. Thank you, C. You use the account cash dividends as it's kind of like a stand-in account to record the amount of the cash dividends, but eventually that account gets closed off to retained earnings. So really what you eventually do is pay the dividend out of retained earnings. It's a reducing retained earnings. The credit to dividends payable, the current liability to show that you intend to pay that dividend out within 1 year from that date, whatever the balance sheet date is. And then again, on the record date, no entry because there's no transaction. You can't journalize, someone just looking through the books. There has to be an actual transaction to make a journal entry. And then October the 31st, the liability, the current liability dividends payable goes down by 200,000 because you're settling the liability, and the asset cash goes down by 200,000 because you are paying the cash to your stockholders. Thank you. That is it. Any questions on this journal entry? Anybody? So it doesn't look like it. I don't expect, because it's basically the same thing as before, right? I told you these entries are kind of a slam dunk. If you get this question, it's the same thing over and over. So please make sure that you just memorize which accounts are involved and also understand how they are affected. When we come back from the break, we'll do or you'll do number 3. Here you have to be careful because there's a journal entry for an issuance of shares, and then you do the dividend and the payment of the dividend. So we're raising the stakes a little bit to make the question a little bit harder, in the sense that it's combining work from chapter 13 and chapter 14. Okay, so it's 11:30. We'll come back at 11:40. I'm not going to stop the recording this time, so I don't end up forgetting to press record. But if anybody wants me to talk to them about something during the break, you're welcome to talk to me. I'll be around. I'm just gonna stop the share, but I'm not gonna stop the recording. So don't give me any personally identifiable information during the break while we're talking about something. All right, so you're on break for 10 minutes.
Professor, can I share with you my screen and show you?
Yeah. So let me make you a co-host, so you can show me what happened with that business with the homework. Yes.
Do you see my screen?
Yeah.
Okay, so here, 7C, you see if I click the correct answer,
Mhm.
the correct answer, it shows common stock first.
Yeah, I don't know what's going on. That makes no sense. Let me see if you. I see what you're saying.
My side or all the like the rest?
I'm looking at the correct answer on my side, and it says preferred stock. Send me a screenshot of that. It's but scrolling to show that this is, yeah, where it says correct answer, so that I can show the Wiley rep that's happening. And then when you stop your screen share, I'll go look again on on my side to see if was, it could be that the question is just programmed to accept both, but it's wrong. I mean, that's what what they're saying is wrong in that case. Yeah, I mean, I don't know what to say because I'm looking at the answer here and it says preferred stock. Yeah, very weird. Very weird. The only other option is that I can look at you. I'll do this later when you send me the screenshot via email. I can look at individual students' work and I can see if something is up with the way your question is rendering the solution. But I mean, I see what you're saying and I agree with you, and I don't know why that's happening.
Yeah.
Mine said preferred, Professor, so maybe it's just a glitch on her part.
Yeah, it must be very weird. Mine also says preferred. That's why I said send me the screenshot. I can speak to the Wiley rep and make sure that there's consistency in how they're how the answer is presented, because it can cause confusion with the students. Okay,
Okay, I'm sending you.
thank you.
Okay, I sent it. Let me know if you didn't receive it or anything. So I'll
Alright.
send it back.
Thank you. I'll check my email on my phone. I don't have my email open on the computer. Yeah, I got it. So I'll check after the class to see if if I can
Okay,
do some detective work and find out why this is happening.
Thank you.
You're welcome.
Cesar,
Yeah,
can I ask you a question about investments?
sure. Whether I know the answer remains to be seen, but you're welcome to ask me.
I never started investing, and I want to start um like
Mm-hmm.
so, but I'm not sure where to invest my money, and like my question is it smart to just invest in companies that you know for sure you're gonna have like they're gonna grow, like Facebook, Tesla, Google, and like, or is it better to invest in different companies in the market,
Mm-hmm.
like
Yeah.
the unknown ones also?
Yeah, so that's a great question. So the first thing I am going to say is that when you are starting out, um, I would recommend that you think more broadly than investing in individual companies. When I mention that I have a few stocks, in this company or that company, that's just that's a little bit of extra money that I can almost kind of like afford to lose or not afford to worry about every day what's happening with that particular company. When you are thinking about, the growth in stocks and what type of return you're going to have on your investment, absolutely a lot of these companies, like your FANG stocks as they call it, right? The Facebook, Apple, Alphabet, Netflix, Google, they're all growing. And that's true, but they also have stock prices that are pretty big, like they're expensive. So unless you have, a really extremely high amount of money available to invest, you probably won't be able to, invest in those individual companies at the level where you're really seeing, massive amounts of growth in what you are, getting back. I'm not saying that you shouldn't invest in them at all. I'm just saying that, if the Alphabet stock is 2,800 for one stock, or how many stocks, I'm not, without knowing your personal financial situation, how many stocks are you really able to buy, or you buying fractions of stocks and so on. So what we normally, when we speak in the Finance Club, when we speak about this at length, I mean, the Finance Club is dormant right now, but when we do speak about it at length, we talk about how when you're just starting out, it's almost impossible to, to beat the market, meaning that when you're an individual investor trying to figure out where to put your money so that you can get, big returns, there are so many people who are already working in the market that are doing all the research, that have all this knowledge, that you're sometimes actually better off investing in like a fund where somebody else is doing the thinking, and they're actually investing in what we would call like a basket of stocks that are in the same industry, and you can benefit from that. So when I was talking to when Sam was asking the question about day trading, I was talking about an exchange traded fund. That's the way ETF, if you've ever heard the terminology ETF. A lot of people who are starting out start on, something like an ETF. So you guys can still see my screen, and I'll just spend, 1 or 2 more minutes talking about this. So I've invested some time back in this. Do you see this VOO? So it's an index fund, meaning that it's basically tracking the market. It's consisting of, a number of shares. I don't have to buy individual shares. I'm tracking the market. When I invested in this thing, it was maybe 2.5 or 3 years ago. It was like 200 and something, per share. And it's already basically, I mean, the market's gone up even in a pandemic. I mean, the market is completely dislocated from the economy. We're not even going to go into that. Basically, the Federal Reserve is propping up the market by buying anyway, I'm not even going to go into that, but the Federal Reserve is managing to keep the market afloat, rightly or wrongly. Capitalism, is winning as usual. But my point is, see, and we can again speak about this at length, and to anybody else who's interested, if you're just an individual investor, you have a certain amount of money that you think you want to invest, or you even want to do what they call dollar cost averaging, where every month you just want to put like $100 into some type of investment portfolio, you may want to start out just diversifying your risk and not going straight into, oh, let me just invest in, Alphabet, but you don't have the time or the energy to actually follow what's happening with the company and make sure that you are investing at the right time and, et cetera, et cetera. Something like an index fund. And the reason I went with Vanguard's index fund is they have very low fees, because these funds do charge a little bit of fees because of the fact that they're basically doing the research for you. Something like that might be more beneficial. There are other things that you can invest in. People are going crazy about cryptocurrencies and all of that. But just like you said, see, you have to invest in what you know, and then you have to define what it means to know something. When you're investing in cryptos, for instance, do you know how to do technical analysis? Do you know how to check, when that coin is setting up for a drop or for a rally, because you actually are plotting out price points and things like that. If you don't even know what I'm talking about, or you're just going based, and by you, I mean all of us, or you're just going based on an article that you read, and maybe now you're just going to throw some money into the thing, you have to be very careful and be okay with the fact that if you're not going to do enough due diligence, that yes, you might make a whole lot of money, which is great. I definitely wish that for everybody, but you could also lose the money. So when it comes to investing, pay yourself first. Make sure that you have an emergency fund of 3 to 6 months of savings. I know sometimes people say, oh, we don't need this anymore now, we should be okay. But if you are covering your own expenses, you need to have money in the bank in case of job loss or whatever. That money should be untouchable. That's not money that you just, play around with in the stock market. And then it needs to be, liquid, so that if something happens, you can get it out, whatever that means in how you do it. And then money that is disposable, that you are okay with, your stomach isn't going to turn every day when you look at what the Dow Jones is doing. Yeah, put it in, maybe a little bit into an actual company that you are familiar with. But if you're talking about really making returns, it's very rare that individual investors are going to beat the market. So you might just be better off tracking the market through a fund. And, we can talk at length about what these funds have returned over time. I won't do that now because we've got to carry on with the accounting. But that's, that's one way of thinking about it. And yes, Sam is also saying use the money that you don't need. And so, see, the last thing I'll say here, and then you can tell me if there's anything else that you want me to talk about. Let me just show you something. The library runs a series called Money Boss. I don't know if any of you guys have ever seen ads for this thing, Money Boss. So this is not actually what I want to talk about, but today they are running one from deficit to surplus, how to get rid of debt. And I forgot to say, if you, and by you, I mean all of us, if you do have a whole lot of debt, like you've got credit card debt that you're paying exorbitant interest on, you got to get rid of that first before, well, not first, but I mean, get rid of some of that before you start putting money away. You don't have to wait forever, but compare the return that you're getting on the market versus how much money you're paying on the credit card, and make sure that you're being wise about where you're putting your money. So see, the thing that I wanted to show you here is, if you look at guides.laguardia.edu/moneyboss, when you look at past workshop recordings, Professor Trapani, who also, and I told you guys about the finance class that he teaches, on April the 29th this year, he did a very nice presentation. Frankly, we could have probably been there for 2 or 3 hours, but he did a 1 hour presentation on investing. And I attended that presentation on that day. It was excellent. And I would highly recommend that if you want to have more information on investing, to also spend some time listening to what he said. He and I work closely with the finance club and, with finance related stuff for the college. So that might also be a useful bit of information for you. see, go ahead. It looked like you want to tell me something.
I think I took this class because I took introduction to business class, but I'm not sure when.
Not
And I
into, I'm
think,
not talking about, oh, sorry, go ahead.
and then the teacher used to give us extra credit for joining this Money Boss
Oh, you
presentation.
took Money Boss.
I
Okay.
took, and I took one with Professor Trapani.
Yeah, because he's done a few of them. It may have been the investing one, or it may have been a different one, because he's done more than one. I've also done one. I did one about like credit, your credit score and stuff. So
But I feel
um
like when I was taking it, I had no knowledge about investment. It was, I
yeah,
think it was a year
s-
ago, and
right.
I
So
didn't know
yeah,
much.
so what's beneficial to all of us now also is that a lot of the brokerage firms, or all of them actually, they don't charge fees anymore for trading stocks. There's Robinhood that you can also buy fractions of shares. You don't have to buy a whole share if it's too expensive, etc. So again, we can talk more about this. I'm sure many people or other people are interested. And if you guys are going to stick around next semester, the people who are interested, I'm going to try to get the finance club up and running again, so that I will definitely be interested in staying in touch with you. But I just want to caution against picking a stock and putting your money there and hoping for the best, because you're not actually studying the stock and all of that. Let somebody else do the work for you if you don't have the time or energy to do it. And maybe just think about investing in a fund. And there are all kinds of funds. I mean, there's the fund that tracks the market, which is what I was showing you. There are funds that track all the tech stocks, so you can invest, like, so instead of just investing in Alphabet, you can invest in a fund that's tracking a lot of tech stocks. There are funds that track, I mean, if you want to talk about like other more esoteric investments, there are funds that track cannabis stocks, there are funds that track healthcare stocks, you name it, it's there. So you may want to think about that as an option. Okay,
And
I know. Go ahead.
how do you start investing in a fund? Do you go to the bank or you do it by yourself?
Yeah, you can do it by yourself. You can so you can, like, I have two brokerage accounts. I have an E-Trade, E-T-R-A-D-E. E-Trade is one type of account that there's also Fidelity. There are many banks that have the brokerage side where you can literally just open an account online and you can deposit some money into the account, and you can, research and decide what you want to invest in, and then you just buy the stock. Or you can do like Robinhood, like a lot of people do, which is basically an app. You join it. You also bring money across from your bank account in there, and then you go through and choose what you want to invest in, and you decide to buy it. So it's basically in our hands these days. We don't have to go to brokerages, to other people to do it for us. We can do it ourselves, but with all that freedom also comes the potential risk of making mistakes and stuff. So you really want to make sure you know which stocks you want to invest in, that you've got the right, what they call ticker, the symbol for the stock, like how you saw the thing I showed you was VOO. You want to make sure that it's the right thing that you're investing in, and you decide how much money you want to invest, and then you can monitor your investments from there. So if you're already with a bank, I don't know what bank you're banking with, you don't have to tell me, but you can see if they have any type of trading, website. If they don't, you can. A lot of people use Robinhood because it's on. A lot of people, like millennials, like younger people, like you guys, basically use Robinhood because it's on your phone. You can check it all the time. It's easy.
But it's
So
risky also, no? You lose your phone, everybody have access
no,
probably.
because no, I mean, everything is password protected. When I have a password to get into my phone, and then I have another code to get into Robinhood. And even then, I mean, yes, they can try to transfer stuff, but it's my bank account that's attached to it. So if someone tries to sell my stocks on the app, I mean, the money is just going into my bank account. They would then have to get into my bank account. So you have to think about how you're protecting everything, not just the Robinhood app, right?
Yeah.
All right. So, now I've spoken I owe you guys 10 minutes of dividends now. But this is life. If we want to build wealth, especially, I'm sorry to put it this way, but especially people like us, like many of us are not coming from, super extravagant, wealthy backgrounds and stuff. You're not going to build that much wealth by just like lumping this money into a bank account, because there's almost no interest. In fact, inflation is increasing, so you're actually losing money by having it in the bank account. So any excess funds that you have over your monthly expenses, your debt repayment, your savings that you need to make, if you have excess, you have to be thinking about building wealth. And I mean, there are other ways to build wealth also. I think it was Ivan who said he's in property management. Property is also another way of building wealth, especially in New York City, where the property prices are always climbing. So it's not just stocks. I just want to be clear that I'm okay. That's fine. Jahomi, I see that you have to go. So guys, number 3, let's go. And Jahomi, it's okay if you have to go. You can just watch the rest of the lecture on YouTube. Number 3, I want you guys to be looking at this. Let's read here. On February the 1st, Slavin Corporation had 65,000 shares of $5 par value common stock issued and outstanding. So on February the 1st, we had this number of shares. This is the par value of the shares. There's no treasury stock because these shares were issued and outstanding. During the year, the following occurred. They issued 35,000 additional shares of common stock for $12 per share. So this piece over here is from what we were doing in chapter 13, stock issuances. So the question is asking you to journalize all the transactions above. So you need to be able to remember how to journalize a stock issuance. Then on May the 1st, they declare a cash dividend of $1 per share to stockholders of record on July the 30th. And on August the 10th, they paid the $1 cash dividend. So I'm going to give you, let's say, until 12:02. Do we see how it goes? 12:02, you guys are going to do this, the however many transactions you think you need to journalize. You do have to journalize the stock issuance. So go ahead, take about 8 minutes, probably too much time, but it's okay. And then I'll take someone who hasn't spoken yet, maybe to walk us through some of this, okay? Number 3, if you've just joined us or if you just woke up or something, we're doing number 3. While you guys are busy, I'm just going to check. I'm looking for a few people that I haven't seen their names yet. Is Wen on the call? Wen Chen? Nope. Michaela, are you here? How about Yadira? No. Ivan, are you on the call? Ivan? No. and Walter, no, John Cardenas, no. Okay, thank you. Sorry for the interruption. All right, I see you, Scarlett. As soon as the time's up, I'll take you. Thanks. All right, 2 more minutes. All right, so let's go on example 3. I've got Scarlett who is going to walk us through. Just bear with me momentarily. All right, go ahead, Scarlett. What should I do?
Cash.
All right, so March the 1st, right?
Yes.
March the 1st, cash. What's the deal here?
420,000.
So how did you get to that?
I
You-
did the 35,000, the shares
Mm-hmm.
times, let me see.
$12.
Yes.
$12 per share.
$12.
That's correct. So it's the number of shares times the issue price. Good. What's next?
Oh, May 1st. Oh, no, I'm sorry.
It's okay. I know.
Common stock. Common
Yes.
stock.
Mm-hmm.
Credit 175. I did 35,000 times 5.
That's the number of shares times the par
Shares.
value. That's
Yes.
correct. And then you
Yes.
end up with
245.
excess. 245. What's that?
That's the additional pay in cash.
Paid in capital, in excess. They could call it, normally companies call it additional paid in capital, APEC, but paid in capital, but I'm going with what the book is doing, which is that super long name, right? Paid in capital in excess of par value. Common stock. I have to extend it's so long that I have to extend the there we go. All right, great. So that's part 1. Anybody have questions here? Okay. Scarlett, you want to continue? What's
Yes.
next?
May 1st,
Okay, May the 1st. Yeah.
cash dividend. 100,000 debit.
So tell us how you got 100,000 is correct, but tell us how we get to 100,000.
At the beginning, February 1st, they had 65 shares, 65,000. And then on March 1st, they issued 35,000. So
Yes.
I added both to be the total 100,000.
That's correct. And then multiplied by, I
One.
think it's a $1 dividend, right, per share. So that's how we got, for anybody who's wondering why the debit is gonna be 100,000. If you put 65,000 or you put 35,000 as your dividend, it means that you forgot either the beginning balance or you forgot about the stock issuance. All right. Remember, when a dividend is declared, Scarlett's talking about May the 1st. When a dividend is declared on that date, you have to look at the number of shares that are outstanding, right, on that date. You can't just go by old numbers, because everybody who has shares in their possession on that date is supposed to be getting a dividend. So these people who had bought the shares on March the 1st won't be very happy if you don't give them a dividend. So it's 100,000 shares times $1 per share. Continue, Scholar.
Then we credit dividend payable.
Good. For the same, right?
Yes,
100,000.
100,000.
Okay, what's happening after that?
August 10.
Is it
Uh,
August
with-
10?
with
Sorry, for some reason. So you don't have to put no entry. Some people probably did this, so I'll just do it on July the 30th. I know that in Wiley, it's probably not going to even give you the space to do it, but just as a reminder, there's no entry for the record date. Continue, Scarlett. On August the 10th, what happens?
We debit dividend payable.
Yes, the liability goes down by the same amount as what it went up in the previous journal entry. And what's the credit?
Cash. Because we're paying.
Yep. Perfect. Thank you. You did it. Any questions, anybody on this, on the whole entry or entries plural?
I kind of had got it right, but then I strayed away.
Or did you stray away from?
So I started, for some reason, I started with I don't know why February. I added February into it first because I thought we had to go
Um,
by the dates in order.
mhm. Now let's
Then
just
I
talk about that. If it says they already had that stuff issued and outstanding, that means that those journal entries were previously made. It's like a beginning balance. All right.
okay.
So you don't have to journalize anything at that point. If you were creating a ledger, you would just put balance. And then, for the common stock, you would have 65,000 shares times $5. But you definitely don't need to journalize a balance that's already in existence.
Okay, got it.
What else did you struggle with? Or was that
And
it?
then I started with cash dividends, and then I
Okay.
did get the 420,000. And then I was just like, I just got so lost.
Yeah.
And I just
So
stopped.
yeah, so it's fine to get lost. In fact, Maya was commiserating with you about the February the 1st. Also, she was saying that she did the same thing. We're never alone. I'm not saying that to sound corny, but like this, it's weird because when we're on this Zoom, it feels like you're just in your own house, like doing your own thing and you getting lost. And you're not the only one that's lost. And I'm glad you brought this up. Um, what's somewhat challenging here with this question is that you're combining concepts from the previous chapter and the current chapter, and you always have to remember with accounting, that's the danger, is that the stuff builds on itself, and so eventually you have to remember things from before. So it's possible, just from what I'm hearing you saying, this is Denisa speaking, right? Or who was speaking now? Am I recognizing your voice properly? Who's speaking? Oh,
Yes,
what? Yeah,
Tanisa.
okay, that's what I thought. Okay, I was just like, let me not like imagine that I'm speaking to someone and then I'm not actually speaking to that person. So I think you were so much in the dividends zone that you actually forgot. That's what it sounds like to me, that you forgot that this was actually an issuance of shares as opposed to a declaration of a dividend. Is that fair to say? That you went in and just started trying to do
Y-
a dividend declaration?
Yes, I agree.
Mhm. So I think the takeaway there is, I guess the kind of, again, cliched, like expect the unexpected, in the sense that a company could be doing various transactions. They don't just all have to be related to the topic that we're discussing in the moment. So you have to read the sentence carefully and kind of situate yourself and say, what's actually happening with transaction? Okay, so we're issuing additional shares of common stock. So that's got to do with the work that we did in chapter 13. The more you practice, the more you'll hopefully be able to see, discern, right, between which transaction, like which journal entries you're required to make. I think it's a very normal and it's a pretty average, mistake to make on a question like this. The other mistake that people make is that they just completely ignore March the 1st and just start doing the dividend declaration on May the 1st because they're like, well, we're doing dividends, so let's not even worry about anything else. Any other points or questions that you have, Denisa? This is helpful for, I'm sure, a lot of people, that you're being open to sharing your lostness with us.
um, I think that is all. I just have to add like what we did in chapter 13
Mm-hmm.
and then just try to remember. So, are we gonna have any questions like specifically like this on the homework?
Yes, it's possible. I can't remember all the chapter 14 homework questions off by heart, but it's entirely possible that a company could do an additional stock issuance before they declare dividends. Yeah,
Okay.
it's just so normal for in business, that I can't even say that you shouldn't pay attention to this, because even if it doesn't show up uh in the homework in a long
Probably
question,
be on the test.
yeah, it's going to be somewhere. So I think for
Right.
you and for others who did the same thing, don't journalize beginning balances. It's the fact that it says they already had shares, that past tense tells you it's a beginning balance. Don't
Okay.
assume that when you're in a chapter, everything in that chapter is only going to relate to that chapter. It could relate to previous chapters, right? I mean, in fact, everything we're doing in chapter 14 is not only relating to chapter 14 and 13, it's all the work that you've learned in accounting from chapter 1, right, of the textbook. So it's very integrated. And then I guess lastly, just read the transactions carefully so that you understand what you're actually reading, and making sure that you're not just blindly copying, the journal entries that you think should be there as opposed to the ones that are actually being asked for. All right, thank you for that. All right, you're welcome. Now, in the next one, number 4, I'm actually going to go back to the notes. And this next piece is about this danger zone that I spoke about that we have in the chapter where there's allocating the cash dividend between preferred and common stockholders. We'll do this example now and hopefully it will help people to understand it a little bit better. But here we go. Instances may arise where a company declares a dividend, which then has to be allocated between preferred and common stockholders, those two categories of stock. As we know from before, preferred stockholders always get paid first. As we know from Tuesday's class, preferred stockholders generally have their dividend expressed as a percentage of par value. So it's a number that is, the same number every year. So you'll always kind of know what the preferred stockholders have to get every year. Then the common stockholders don't have a set dividend number because they get whatever is left over, either it's 0 or it's some other number greater than 0. And the allocation, like I said, is going to be determined by obviously the dividend percentage, but also this notion of whether the preferred stock is cumulative or not. Remember we said cumulative, right, when we were speaking on Tuesday. Cumulative means that even if we did not pay the dividends to, let's say, to preferred stockholders in 2020, now that it's 2021, we owe them 2020 and 2021. Non-cumulative means if we didn't pay you the dividend last year, this year we only owe you the dividend for the current year for 2021, and it's too bad if you didn't get last year's dividend, you lose it if it doesn't get declared. All right, so often people start having issues with this work when the dividend is cumulative and there's previous years that haven't been paid, which we call dividends in arrears. And you kind of have to keep track of that because all of that has to be paid first before you can pay the common stockholders. All right, so I'm going to do this example 4 with you, and then, we'll see how people are feeling about it if there are more questions after we've done it, okay? So again, example 4 is about allocating a dividend between preferred and common stockholders. And this is, let me actually just also show you, this is also dealt with, generally decently in your textbook. But it's kind of the same example. I just pulled it from the textbook and it's also just going to show you how to do it. The topic doesn't cover a lot of ground in the textbook, but it's an important topic in the chapter. And for whatever reason, it sometimes causes some consternation with people. So assume that at December 31st, 2018, IBR Inc. has 1,000 shares. Okay, so there's a number of shares of 8%. So that's the dividend percentage, $100 par value. The 8% is on the par value. So it's $8 per share, right? Times 1,000 shares. So it's $8,000 of preferred dividend, right? Cumulative, meaning that if we don't pay them this year, next year, we're going to have to pay them for 2 years and so on. Cumulative preferred stock. Okay, so a short sentence, but a whole lot of information that you have to be able to digest. And this is the case for chapter 13 and 14, that, you get a sentence that's full of numbers and percentages and words, and you have to make sure that you understand what those words mean. It also has 50,000 shares. Okay, number of shares of $10 par value common stock outstanding. Now, remember I said that the par value on the common stock is not going to, be incorporated into any type of calculation for the dividend for the common stock, because the dividend for the common stock is not set. the directors declare a dividend of $6,000. So this is the end of 2018. There's a $6,000 dividend. How much of the dividend is allocated to preferred stockholders and how much to common stockholders? So the first step, and I'm going to do it on the solution sheet here in a minute. The first step always when you do these questions is to calculate what is the annual preferred dividend, because you need to know how much those preferred stockholders are supposed to be getting every year. That will help you to then determine, what do they get every year? Did they get paid in previous years? What should they be getting total, right, in the current year? And what can be given to common stockholders? So let's go in and try to figure that out. So example 4, so this first step 1 is to calculate the annual preferred stock dividend, right? And so it's going to be the number of shares times the dividend percent. I mean, the order in which you put these things doesn't matter because you're multiplying everything times the par value per share. Right, so when we look at the question again, we know that the number of shares is 1,000, the percentage is 8, and the par value is 100. So it's 1,000 shares times 8% times 100. And that's going to be $8,000 annual dividend is what they are supposed to get.
Calculation.
Huh?
I don't understand this calculation, the reason for it. Why do we do?
Okay. So basically we're doing it because we need to see what the company has to pay to preferred stockholders before they can even give anything to common stockholders. Okay, and it's the same amount every year. So once you've established the amount, you will be able to see how much of the dividend that was declared belongs to preferred stockholders and how much of that dividend belongs to common stockholders. How's that?
No, I know what's the reason for the calculation. I just don't understand why do you calculate it that way to know what's the dividends are. Like
What's
why
it-
do you do number of shares by dividend percentage by
Oh,
par
you're
value?
okay.
Like, how do you calculate the dividends being given to
the 6,000 or the 8,000? What do you mean this?
8,000? Yeah,
What's the alternative?
I don't know.
This is that's so. I mean, I'm not saying that to be
That's
facetious.
like
I'm
the-
not saying that to be facetious. This is the dividend is expressed as a percentage of par value, and each share has a par value. So there's no other way to do it.
Mhm. Okay.
Maybe that's the key that you're looking for. The 8% is an expression as a percentage of par value. And
Okay.
par value is attached to each share. So this has to be the way. to
Oh,
do
I
it.
got it. Okay.
Okay.
Yeah.
I think I only understood your question properly, like the second or third time that you actually asked it. So sorry, I was also lagging behind you. So that's the annual dividend. And now you also have to be careful here because it is cumulative, right? So this means that we need to keep track of whether the dividend is paid in full or not, because anything or any dividend not paid in prior years has to be paid first before we pay current year dividends to preferred stockholders. And remember, only after we have paid all arrears and current dividends to preferred stockholders can we pay common stockholders. Okay, that's what we mean by residual interest. Remember, you all have access to this document, so this is not existing in our notes. I'm just typing as I'm speaking just to make sure that people understand, because cumulative is really the crux. It's the kind of the thing that the entire calculation revolves around, because as soon as something is cumulative, then you start having to keep track of how much money has been paid, how much money is still owed, etc. Okay, so please make sure, and also this comes up in the homework, it comes up in the test. There's scenarios. Sometimes they say that the dividend, that the preferred stock is cumulative. Sometimes they say it's non-cumulative, and so I'll just also, for the sake of completeness, say that non-cumulative. That means that if the dividend is not paid in any year, it doesn't carry over, right, to the following year. So any dividend not paid is lost. Okay, so we don't have to keep track of stuff. It's like, if I didn't pay you this year, it's too bad. So now you might think, oh, but isn't that bad for the preferred stockholders? Remember, they agreed to all of these terms at the beginning when they decide to buy the stock. So it's no one's being robbed of anything. They know that it's cumulative or non-cumulative, and they've agreed to those terms. So now we know that it's an 8,000 annual dividend and that it's a cumulative preferred stock. And so now the dividend, so that was step one. You don't have to write all of this stuff. Step one was to calculate the preferred stock. So now step two, you're going to allocate, right? The dividend, the total dividend, let's call it the total dividend declared between preferred and common. Okay, so when we look at the question, we see that it's a total dividend of $6,000, right? That isn't being assigned to anybody. The company is just saying we're paying a $6,000 dividend. We have to now figure out who that goes to. So at $6,000 declared, so now you go back and you say, how much should go to preferred? Well, 8,000 should go to preferred, right? Based on our previous calculation. Well, we have a problem because we only have a 6,000 declaration and 8,000 is actually the annual dividend. Can we pay them 8,000 if we only declared 6,000? No. All right. 6,000 is what is declared. Therefore, the preferred gets 6,000. Common gets big fat 0. And then you still have a problem because there is $2,000. So this is 8,000 minus 6,000. $2,000 dividends still owed to preferred stockholders. And that we call in arrears, right? That will carry over to the next year. We can't pay them money that we didn't declare. So unfortunately, it's 6,000 paid, but there is 2,000 arrears. And we will have to see in 2019 how much dividend is declared to see if we can even pay that arrears. Questions, anybody on any part of this calculation?
Wait, what is arrears again?
Arrears is the amount that's still owed that should have been paid and wasn't paid.
Oh, so it's kind of like a payable thing.
Yeah, except that weirdly, it's not going to show up as a payable anyway because the dividend, that amount was never declared as a dividend. So we kind of just have to keep on our books a note to say that we still owe them 2,000.
Oh, okay. Thank you.
Okay.
So, Professor, that will basically have to roll over into the next year.
Yeah. Yeah, and so this is what I mean about where these questions get a little bit sketchy and tricky, because next year when they declare dividend now, we have to remember to Lewis's point about almost like a payable, we have to remember that there was a 2,000 arrears from the previous year before we even, put down the dividend that we are paying for the current year.
And then, so what about the okay, got it.
Cumulative, yeah, but this was cumulative.
This is
That's
cute.
why.
Yeah, just
Yeah,
realized. Okay.
yeah. So let's look to see what's happening next. So prepare the entry for the dividend declaration. Okay, so that's fine. So now I'm going to do a journal entry over here. So you don't care about this, but I'll just say back in the day, the book used to, oops, sorry. Back in the day, the book used to separate the dividend payable between common and preferred. It doesn't do that anymore. So literally our journal entry, which is the B part of this question, and this is the answer for the A part. After all that talking and writing, that's the answer, right? For the B part, the dividend, the journal entry is literally just cash dividends. And it's the 6,000 that was declared, not the 8,000 that was calculated, 6,000 that was actually declared, and the dividends payable the same. And sometimes, people will make a note and say, 6,000 to preferred and 0 to common or something, just to show how it was paid out, or how it would be paid out when it's paid out. All right, so that's the journal entry for the declaration. At December 31, 2019, so again, yeah, you got to watch the dates, you got to be very attention to detail, right? Bring out your monocle, your magnifying glass, whatever, make sure you're looking at the dates properly. So this is the next year. IBR Inc. declares a $50,000 dividend. So that's a much bigger amount. How much of the dividend is allocated to preferred stockholders and how much to common stockholders? So now for number 3, sorry, I was putting ABC, but it's actually 1, 2, 3. So I'll just change this. For number 3, now you're gonna say, okay, so the dividend, okay. This is me being unnecessarily ridiculous with wanting to make this look right. Sorry, forgive my pedantic ways here. So for number 3, we say that the total dividend declared is 50,000. We know from before, so we don't have to calculate it again. We know from before that the annual dividend for the preferred stockholders is 8,000, right? So we know that the annual preferred dividend is 8,000. We also know that dividends in arrears from 2018 is 2,000. Got to keep track of it. So now let's see how we pay this out, right? So you've got preferred, right? Preferred. So the way I do it is I'd say, what was 2018? What's 2019? So preferred for 2018, the arrears, we got to pay out the 2,000 first. We still have money left over because we declared a dividend of 50,000. Then we pay the 8,000, that is the 2019 annual dividend, because they should be getting that as well, and we still have the money to pay it because of the size of the dividend. So if you add these two together, obviously 10,000, right, goes to preferred stockholders, which then means the common stockholders are going to get the difference. So they're going to get 40,000, which I know it's obvious, but I'll just put it here in case someone forgot, which is the 50,000 total minus the 10,000 that goes to preferred. So that's how you split it with this 2,000, arrears amount from the previous year. And the reason we bring the arrears forward is because the preferred stock is cumulative. Questions? And then they ask us to do the journal entry again in number 4. So this is literally just repetition because it's the same thing. So I'll just do it really quickly. So it's, sorry, cash, dividends, and dividends payable. And notice how we don't take the 2,000 or the 8,000 or the 40,000. It's the total 50,000 that was declared is what is being journalized. And then you could say something like 10,000 to preferred, sorry, 10,000 to preferred, on type now suddenly, 10,000 to preferred and 40,000 to, what is going on with the space bar? 40,000 to common, right? That's the split.
Professor, so why does the common stock, common receive more than the preferred if the preferred is getting um the first share?
Yeah, so great question. The answer is just because you're getting the money first doesn't necessarily mean that you get the most. It means that you are getting what you are owed first, and because the preferred dividend is a set percentage of the par value, the amount of money that the preferred stockholders get is actually, limited to that percentage. They can't get more than that. All right. So if the dividend that's declared, remember the dividend declared over here was only 6,000, they can get less than that because the dividend was too small, but they can never get more than that. Notice that we just paid them what was owed from the previous year, and then we gave them the 8,000. Where does the 8,000 come from? It's set. The terms are set, right? It's 1,000 shares. It's an 8% dividend per share. It's $100 par value. So this is in this case, it's the benefit of being a common stockholder is that you get the leftovers, you get the residual amount, and that residual, in the previous example, the residual was 0, so they got nothing. In this example, the residual is higher because the dividend that was declared was big. So I guess, again, to reiterate, just because you get paid first doesn't mean that you have to get more money than the person who's getting paid second, because preferred dividend is a set amount.
Got it. Thank you.
All right. What else? So let me ask this question because it can come up. It's not built into, into the formal question, but what or how does your answer, how does, me, I'm going to be extra, right? How does your answer change if the preferred stock was non-cumulative? And let me actually be very specific. How does your answer for 2019?
Then they would receive only 8,000 instead.
So exactly. So total dividend is 50,000. Preferred gets only 8, and I'll actually put it here. They only get 2019, so you know where the 8,000 is coming from. They only get 8,000, and common will get 42,000. So no arrears carried forward from 2018 because it is non-cumulative. Use it or lose it, right? So it doesn't matter that they only got paid 6,000 in 2018 if the stock is non-cumulative. You just, each year is a new beginning, and they just get paid for that year. So here to the point who was asking, hey, why are the common stockholders getting so much money? They're getting even more money now, right? Because the preferred stockholders agreed when they invested in the preferred stock that they were investing in a non-cumulative preferred stock. Anybody need clarification on that? Okay, so like I said, this part of the work, for whatever reason, gives people some headaches. So there is a whole, there's I think at least one, maybe two homeworks it's long that goes through, like it changes the dividend percentage. So you need to make sure that you know how to calculate the annual dividend. It's giving scenarios of if the stock is cumulative or non-cumulative. So you're practicing to do the split, right? To do the allocation between common and preferred with all different scenarios of what the preferred stock, what the characteristics of the preferred stock are. Okay, so look out for that. That type of question will also come up in the test. So in the dying moments here of our time together, I'm not going to go too deep into, I'm not sure if this page reference is correct, so that's why I highlighted it here. So don't worry if you're looking for the page numbers. I'll show you next time in the book where this information is. When we get together on Tuesday, I'll start talking about stock dividends. Basically, just to give you, kind of a coming attractions or highlights of what this means. It's also a proportional distribution, like how a cash dividend is in line with the number of stocks you own. You're getting cash. In this case, instead of getting cash, you're getting stocks, okay? So the account that we will use, instead of saying cash dividends, no surprise, it's going to be stock dividends. But because the company is issuing stock as the dividend, we have to try to calculate how much dollar amount, right? What's the dollar amount of the transaction? It's easy to calculate the dollar amount of a transaction when it's being expressed in cash, right? Because that's just the amount. But when you're giving someone a stock, you actually have to determine what was the fair market value of the stock, right? And the stock dividend, when we talk about it, it's going to be expressed as a percentage. So of the number of shares outstanding. So you could say something like a company has 100 shares outstanding and they declare a stock dividend of 5%. That will mean that they are issuing 5 shares in the stock dividend. I'll repeat. A company has 100 shares outstanding and they declare a 5% stock dividend, that will mean that they are issuing 5 shares in the stock dividend. We'll do examples, so don't panic. But I'm saying all of this to say that we don't know then what the dollar amount is, right? Because it's a stock, right? So we do get given guidance that we will use the fair market value of the share. What does that mean? Fair market value of the share. If we look at the alphabet shares being Google, this is the fair market value, the stock price on the day of the stock dividend declaration. So if Google said today that they're doing a stock dividend, I don't know why they would do it. They've got like billions of dollars in cash, but let's just pretend, right, that they're doing a stock dividend. Then they'll say, what percentage of the number of shares outstanding is going to be in the dividend. So maybe it's a 10% stock dividend. And then to get to the dollar amount for that, we will have to look at what is the price per share on the date of the dividend. And then we record it. It's basically, right, the stock dividends name is here, but then it gets a little bit tricky afterwards. So I'll leave that for your excitement next time. I'm sure no one is excited about that, right? But if you want to read in the book also, the stock dividend stuff starts right after the piece that we just finished about allocating dividends between common and preferred stock, and it also talks you through the entries for the stock dividend and the effects of the stock dividend. What ends up happening, just briefly, is that you obviously don't pay any cash, right? So there's no assets involved, there's no cash being paid out. You're basically just moving money from retained earnings and into common stock because you're issuing stock. So it's actually just changes in the stockholders' equity accounts with no impact on cash because it's not a cash dividend. So that's the deal with stock dividends. Another hot topic where people don't like, I don't want to say don't like, but people get stuck on stock dividends because there's a few steps to the calculation. So don't miss the lecture next week. And also please make sure that you actually understand what I'm talking about when we get together. So you guys are dismissed. I'll still stick around here if someone has questions about something. And I repeat, the chapter 13 homework is due on Tuesday, all right, at 6 o'clock. So please, please, please make sure that you get a start on it. I just want to make sure that people are not throwing away 5% of their grade from not managing their time well. Okay, have a good
Thank you,
day.
guys. Thank you, Professor. Bye, everyone.
You're welcome.
Thank you
Have
so
a
much,
Have a
good day.
great
Professor.
day.
Have a good one.
Thank you so much, Professor.
You're welcome. Bye.
Thank you.
Professor, can you show me where until where in the textbook should I read?
Sure, let me see what I'm gonna do next time.
Thank you.
Okay, I'm just checking with people.
I'm sorry, I'm so annoying.
You're not, no, you're not annoying at all. I really appreciate the fact that you are reading ahead because this is what we should be doing. I respect it and I want to make sure that I'm giving you good information. So please
Thank you.
don't think that you're annoying. I'm not annoyed at all. Okay, so next week, Tuesday, I would not yet be going over the chapter 13 homework because it's due that day. So I'm probably gonna end up going almost right through this chapter. I would read until the income statement presentation.
Okay.
But it's possible that I may even get to that. It just depends on how many questions people have and how many times I go over things and how long we take to get through the examples. But I mean, I'm not trying to push too hard to finish the chapter on Tuesday at all, but we will probably finish the chapter on Thursday, the 14th.
Okay.
Mhm.
Okay,
So
thank
you
you.
decide. Okay,
Have a good day.
you too. Bye-bye.